Very warm welcome to this JustShare debate tonight. For those of you who don't know JustShare, we are a coalition of churches and charities aiming to engage specifically with the City of London on issues of global and local social and economic justice. To find out more about us, do please sign up to join our mailing list, which you'll find at the back of the church. A couple of housekeeping notices before we begin. First of all, if there is a fire, please leave. You'll find the doors at the back. Secondly, sometimes our microphones are a little bit temperamental, so if you can't hear, the best thing is to move forward a little bit and you'll pick up the sound much more easily. Regulars will know that usually after our debates we have fair trade wine, but as it's Ash Wednesday, the first day of Lent, tonight we'll just be having some orange juice, but do please stay around and join us anyway. Carrying on the fair trade theme, next Wednesday, the 29th of February, we have Paul Chandler, who's Chief Exec of Tradecraft, talking about fair trade and Christian attitudes to the market. So do come along for that if you can as well. Let me now introduce Lydia Prieg from the New Economics Foundation. She has a background in physics, Goldman Sachs and political science, and she's in the business and finance team of the New Economics Foundation, so very well placed to introduce our debate tonight. Thank you.
Right, hello ladies and gentlemen. Can everyone hear? Yes? Okay, yes, as discussed, I'm a researcher at the New Economics Foundation. We're here today to talk about an important issue, which is food speculation and the role it may or may not play in rising food prices. I'm sure, as you've all seen in, for example, 2008, when we had a food price spike, we saw riots break out in places like Haiti. And the question is whether or not these high prices are down to supply and demand fundamentals, like, for example, the fact that more land is being set aside to use to grow biofuels, or whether on top of that there are additional factors, which is the fact that pension funds, hedge funds, banks invest in commodities via derivatives. And so here today to debate this, we have two speakers who will be taking opposing sides of the arguments. First of all, we have Deborah Doane, over on my right. Deborah is the director of the World Development Movement, which has been running a very high-profile campaign against food speculation. Since 1996, she's been working on ethical trading, human rights and sustainable development issues. And she actually has a background in, well, at the New Economics Foundation, where I work now, and also running humanitarian projects for the British Red Cross. And she's also a frequent guest lecturer talking on issues to do with sustainability, human rights, and corporate accountability. Then on the other side, on my left, we have Anthony Belchambers. Anthony is a barrister by trade, but he's also the chief executive of the Futures and Options Associations. And futures and options are two types of the derivatives that that I was just talking about. On top of that, he's also the vice chairman of the administrative committee of the European Parliamentary Financial Services Forum. He's the principal spokesman for an EU-US coalition on financial regulation, and the General Counsel for the UK Joint Exchange Committee, where his responsibilities include coordinating exchange activities and lobbying on behalf of the London-based derivatives market. So two very different backgrounds. Just to give you an idea of the format of this evening's event, I'm going to allow both speakers to talk initially for 10 minutes, so 10 minutes each. Then I'm going to throw it open to you guys for questions and give both the speakers then a chance to respond. So first of all, can I start with you, Deborah?
You could hear me anyways, couldn't you? I can speak loudly. Do I need to repeat that? There are a host of reasons for this, but one of the major causes of this is rising food prices. Donations to the food crisis in sub-Saharan Africa last year, if any of you were compelled to do so, actually bought half as much food as it did in 2001, 10 years earlier. According to the FAO, the Food and Agricultural Organization, food prices hit an all-time high in February last year. And while they've fallen slightly since then, for 2011, the average was still a staggering 23% higher than 2010 and 14% higher than 2008, when we saw the last food price spike. The price of maize, a staple crop in developing countries, shot up by 180% in 2007 and 2008, wheat by 60%. We feel this in the UK. Food price inflation here is now at 5.5 5%, roughly, over the last 12 months. It's a period when pay and benefits are stagnant, and it affects the worst off. Food budgets in poorer households, in particular in the developing world, can account for as much as 60, 70, 80% of an entire household budget. If food becomes unaffordable, your long-term survival is at risk. You might forego so-called luxuries like healthcare or education. You might sell off your assets like livestock required for investment in the future of agriculture. You will certainly forego a balanced diet, leading to malnutrition and increased hunger. For those living on the margins, a short-term spike in prices can cause a downward spiral into chronic, long-term, and deepened poverty. At the societal level, as Lydia mentioned, we see social unrest, we see food riots, and eventually revolutions, which we saw around the world last year. The question is, though, does commodity trading do this? How does commodity trading directly cause these increased prices and this volatility in prices? Global food reserves have not suddenly dropped off a cliff. In fact, supply is actually, at the moment, keeping very good pace with demand. There are long-term gradual pressures on rising food prices from an increased use of biofuels, rising oil prices, or reduced yields due to climate change, for example. But none of these on their own are enough to explain those fluctuations of 180%, of 60%, those spikes that we're seeing. Banks, like Goldman Sachs, earned $1 billion off of commodity trading. Barclays Capital earned in 1 year about $540 million. Both have been pouring huge sums of money into food derivative markets, both their own money and facilitating others to move into these markets, which they make a commission from. Their speculation takes advantage of the natural price fluctuations and causes huge volatility and destruction in their wake. There are three ways in which commodity speculation directly causes harm. First, they cause short-term price volatility, which sends confusing signals to growers on the ground and raise prices for the poor consumers beyond their ability to feed themselves. If you're a smallholder farmer in a developing country, if prices are volatile, and they do see the signals from the futures markets, you don't know what to do with your production. You don't know how to expound, what to plant, because the price might drop significantly the following year. And this is exactly what happened after the 2008 crisis. Prices went up, and then they shot back down. This happens here in the UK. I had a conversation with a Welsh farmer not very long ago who told me that, yes, prices were high now, but he would not take the income earned from that and expand production to feed the world because prices might fall just as quickly. The prices that they're seeing in the markets do not reflect what's happening on the ground. Those producers who are using these markets to hedge their risk are paying more because volatility actually increases the margins they need to pay. When prices fall, reductions are passed right down to the supply chain to producers whose costs and margins are squeezed. But when prices recover, those benefits are rarely passed on. They're absorbed by others in the supply chain, including food processors and manufacturers alike. And interestingly, we're seeing that here in the UK in energy markets right now. The big energy firms not putting down not reducing their costs of wholesale gas prices unless pressurized through campaigning. Meanwhile, poor consumers forced to pay the higher prices, and this is actually the majority of people in the developing world, go without. We see many of the impacts noted earlier. We know that just a month or two of high food prices that restrict a family's access to an adequate diet can be enough to permanently affect a young child's development. This is significant. The second thing these markets do is they increase manipulation and herding behavior. By having unregulated markets, speculators are encouraged to behave in ways that are actually the antithesis of a well-functioning market. So we have something like the Armajaro hedge fund, which we call known as Anthony Chalkfinger Ward, who cornered the European cocoa market by buying pretty much Europe's entire supply of cocoa in July 2010, pushing prices to a 33-year high. More recently, we had Frontier Agricultural Grain Traders who bought up all the contracts on the London feed market in May 2011. Wheat futures at the time climbed 45%, from £153 per tonne the previous October to over £222 per tonne. In both of these cases, manipulators use the futures markets to corner the physical market. When we get news of a wheat shortage, say in Russia, such as following wildfires in summer 2010, traders pile into those markets thinking there is money to be made. They drive prices up at a time when supply may actually be fine. And when those prices went up because of threats about crop failure in Europe, there was in fact the third highest global harvest ever. It was not reflecting the fundamentals of supply and demand. Commodity traders talk about balance in markets, that for every buyer of a contract there is a seller. Unfortunately, this oversimplifies something rather complex. If there's a huge demand on one side of the market, traders will demand there's a premium on the other side, inflating the price. And it's not me saying that, it's Goldman Sachs. They said this to the US Senate. Buyers need to enter the market, drive the market price to the place where it attracts the sellers. That's the natural balancing act that goes on day in and day out, driving prices up. In sum, the level of speculation we're now seeing in these markets means that informed traders could no longer trade against bubbles to correct prices because they're outnumbered, and it herds the price upwards. Finally, they mask fundamental information on supply and demand, and I've already touched a little bit on that. But what can happen in food commodity markets is as much to do with other markets. So changes in prices of oil or other commodities can have as much impact on the price of food. The baskets of goods invested in by, say, commodity index funds usually includes both food and non-food alike. So speculators' response to a war in the Gulf, which impacts on oil prices, can impact on food prices in Kenya. In theory, of course, all traders make their trading decisions based on transparent information, a functioning market. With all available data to hand, that's the miracle of the free market, isn't it? The problem is that most of the basis on which trades are made has little to do with the fundamentals and transparent information. So as I said, they might base their information on oil prices or on the merger of Glencore with Xstrata. They might be hedging against changes in other markets, such as shares and bonds, and so on. The 2007-2008 rise in commodity prices came immediately after the subprime mortgage crisis, and that's because the hot money, in part provided by our governments through quantitative easing, was looking for somewhere to go. Since deregulation in the 90s, so these markets were fully regulated and managed until the mid-90s, the balance of market share in Chicago of purely speculative trading versus legitimate risk-based hedging has gone from 12% to 61% of the market. There is no reliable data on what's happening in food markets. Contracts are not transparent because they're conducted in opaque over-the-counter deals where no one can see what's happening. And traders are basing decisions on factors that have little to do with reality. So the question is, can any... He said this, okay. The question is, can anything be done? Well, a steady stream of lobbyists have actually been knocking on the doors of the European Commission, the UK Treasury, George Osborne, to convince us that re-regulating commodity markets where we were just 15 years ago would be harmful to the city. Barclays, for one, had 15 meetings with the Treasury in the time when the new government took office. A Times investigation last year found that it was actually possible to bribe MEPs to manipulate draft regulations that were being produced by the European Union to regulate these markets. Prior to deregulation, two key things were in place since the Great Depression that kept food commodity markets relatively stable, and these included transparency, which is a matter of simply ensuring that all trades are done on open exchanges, so at least we can see what's going on. And secondly, what we call position limits, a limit on the number of contracts any one company can hold. Now, this is more controversial to some commodity traders because they argue it would decrease what they call liquidity. Position limits, in our view, and in many others, is a clear, effective, and transparent way to ensure that trading is based on market fundamentals. And it's a way of preventing any one trader from controlling a market and bringing balance to food markets. Adair Turner, the head of the Financial Services Authority, has said that more liquidity at some point actually provides diminishing marginal returns, and it can facilitate pure speculation. What WDM says, the World Development Movement, is that we need rain, not a flood. Position limits are used on exchanges in countries from like India, China, Brazil, South Africa, and they are being reintroduced in the US. They worked well for most of the last century. Why not here in the EU? So to conclude, can I conclude?
Very
or should I leave
quickly,
it there?
30 seconds.
Okay. I mean, the main question of the debate, does commodity trading help or harm developing countries? We won't get rid of commodity markets anytime soon, but their original purpose to manage risk is a laudable one, but they need to be brought under control and they need to be managed and regulated through very precise means. Thank you.
Thank you very much, Deborah. I'm now going to hand over to Anthony before we throw it open to questions. So Anthony, 10 minutes.
Well, look, this is a deeply sensitive topic, and I'm fully aware of that. And let me make 2 points at the outset. First of all, it's absolutely right for governments to be concerned about high prices and the social and economic impact of those prices, particularly in consumer-sensitive commodities. And secondly, everything you've said about the poverty, the impact of high prices in poor countries, I couldn't quarrel with any of that. I mean, I think that's absolutely right, and I think it's appalling, and I think there are real issues that need to be addressed actually in the food distribution. But we can't get to the right solutions if you don't actually start thinking about what the problems are and getting accurately to those problems. And let me just cite a few of them. I know you've mentioned some of them, but let me cite a few of them before I come to the issue of speculation. First of all, supply and demand imbalances. Every single report that you will ever read on commodities and the high prices and food prices particularly, you will see that appearing right at the top of the list. You will also see production problems. There is serious underinvestment in farming at the moment. There has been for a very long time. If you look at geopolitical instability, and one talks about price spikes, but some of you, well, probably not many of you, may remember the time when Saddam Hussein invaded Kuwait. The price of oil shot up by 40%, and then it came down by about another 30% in the same day. So price spikes are not just a matter of speculation. They can happen with geopolitical shocks, they can happen with climatic shocks, and so on. Government policy has a big part to play in distorting prices. You only have to remember the CAP, remember tariffs, there are price subsidies, there are all sorts of protectionist practices, including trade barriers that go on all the time, which affect prices. Weaknesses in the distribution chain, self-evident. The European Commission has already produced a number of reports on this, saying that they have to do something about strengthening the distribution chain. And lastly, corruption in some of the poorer countries, where aid is deflected away, the guns for butter dictators in some of these poorer countries. So there are a number of other things that we need to think about. But let me come to the issue of speculation. 4 caveats. And we need to understand that speculation is not necessarily manipulation. We must be very careful about language here and get it absolutely right. So, for example, speculation, I would say, is lawful short-term trading, which is designed to try and produce a profit on a price, usually where the asset is perceived to be either undervalued or overvalued. It should not be confused with manipulation. Cornering the market is a criminal offense. It's nothing to do with speculation. Speculation can be a vehicle for a criminal offense, but so can all sorts of other activities that are not speculative, create criminal offenses, what is called market abuse. So unpack that. Speculation is lawful, manipulation is unlawful. The other thing is to make just a few points before I come to speculation as a cause in the market. It's been an integral part of all forms of markets and economic activities. Trading on price, nothing new about this. It's been going on for centuries across all economic sectors. We also talk about financialization of the commodity markets. Now, speculation, yes, is a part of financialization, but so is perfectly legitimate hedging of portfolios. So is perfectly legitimate anti-inflation hedging. And that's because commodities happen to move at a different time in the economic cycle to the more traditional forms of investment. So again, I think all these terms need to be unpacked a bit. The last thing I'd say on this, before I come on to speculation particularly, is free markets are intended to be precisely that. They're supposed to be free of government intervention. They're supposed to be fairly and reasonably accessible to anyone who's fit and proper in those markets and has a legitimate trading motivation to trade in those markets. You should not be in the business of intervening in markets. You should not be in the business of depriving access to those markets without good cause. So, if I move on now to what is speculation, what does it do? And let me just make one point before I come to that. And that is, governments always love to talk idealistically about free markets, except when those markets discover prices that are awkward, embarrassing, difficult, unacceptable. But if they're true prices, then that's the way it is. That's what markets are supposed to do, is reveal true price. And what often happens is, of course, if you take Greece, what happened with Greece? Suddenly, the markets realized that Greek sovereign debt was massively overvalued, and when the price fell, everyone turned around and said, and the Greek government turned around and said, it's those wicked speculators. No, it wasn't. It was all to do with a failing Greek economy that the markets discovered, and without the markets discovering that, the politicians would be schmoozing the answers out of sight of the public. But the markets exposed what was going on with the Greek economy. So it's very important, again, be careful about blaming the messenger if the message is actually telling you the truth. Okay, so let me come to the position of speculation. The first thing is we commissioned this report from an independent consultant called FTI Consulting. And we asked them we didn't ask them to produce any statistics or anything like that. We said, look at the last 20 reports that have been produced on this topic and tell us what your conclusions are. Tell us what the evidence shows. So I'll tell you what the evidence revealed was. Yes, speculation can and does generate short-term pricing bubbles and spikes, usually intraday, very seldom running out for a month, but they are short-term and they can amplify price trends. But remember, when we're talking about price trends, they can amplify trending prices down as well as up. And it's equally true to say that very often speculators don't create a trend, they follow a trend, so they amplify it. Secondly, speculation is key to market depth and liquidity. It is absolutely essential. And if I can put it this way, they are essential to taking the risk transfer trades of real economy enterprises in those markets in order to enable them to manage their underlying risks. But is speculation a key contributor to what some have argued is long-term price increases? Well, I would say, in its very nature, speculation is short-term. That's simply not the case. It's just fundamentally not the case. But who do we have? And we've got lots of reports on this. So in the red corner, or in the camp that, yes, it is, you've got the World Bank and UNCTAD. And then in the blue corner, or the no, it doesn't camp, you've got the OECD, the International Monetary Fund, the US General Accounting Office, the US Federal Reserve, and the International Energy Agency. So I would argue that the weight of opinion is quite the opposite to what's being argued on the other side of the pulpit. Which leaves us very simply with the issue about excessive speculation. Now here there may be a case, and certainly in small markets, if you have excessive speculation, it can distort price. So there's clearly a case for the market supervisor or the exchanges intervening to take down a position, to transfer a trade, to close it down, to reduce it, which is what they do if they see that happening. If it's manipulative, then that's dealt with by the regulatory authority and it may become a criminal matter, depending on what the activity is. So I just want you to put aside market abuse and market manipulation. Okay, so exchanges have wide powers of surveillance and they exercise them. I know for a fact that they've told speculators to take down positions where there have been problems. There is going to be much more increased transparency in the marketplace. There's going to be trade reporting. There's going to be position reporting. There's all sorts of things that are envisaged under new regulations which are going to make markets significantly more transparent. Okay, another point. It's said that speculative trading has increased massively in the markets. To some extent, that's true. I mean, if you think about it, as I say, if you like, put it this way, that fund managers and others become more aware of commodities as an alternative means of investment, anti-inflation hedging, and so on. But one must also remember that these markets are going global, that the volumes have increased across the board, not just speculators. People have become much more aware of the use of derivatives to manage pricing risks and other forms of business risks, so they trade more in those markets, and they become global, so more people are trading in those markets. So it's part of a general trend of increased volumes. I want to close on 3 quick points. And the first point really is, and I've made the point already, we are talking about free markets. We must be careful about encouraging any form of government intervention in restricting access to a marketplace. To restrict access to an open and free market is a serious matter, and it should be done on the basis of cause, and it should be done on the basis of evidence. So that's the first point. My second point is the integrity of the price formation process in the marketplace. That is absolutely paramount. And even if its pricing outcomes are awkward, difficult, unacceptable, that pricing truth that the market is giving is really important, because by the virtue of that truth, you can measure what you need to do at the point of consumption, if it's a question of subsidy, targeted subsidies, or at the point of production, or at the point of distribution. It can help you decide what you need to do and how much you need to do. And I just want to quote actually what the World Bank Task Force said about this. And this was a task force.
Just to let you know, you've got 1 more minute.
1 more minute?
Yeah.
Right, I can finish in a minute, I'm sure. Basically what they said, and I quote, "It is not possible or desirable to eliminate price fluctuations in commodity markets. Neither is it sustainable for governments or multilateral agencies to interfere in market mechanisms to suppress price changes." These are free markets. Be very careful. Don't confuse price, if I like price formation. Don't allow governments to use that as a backdoor means of imposing soft forms of price control. So that's the second point. Third point, speculation is a lawful and necessary part of the efficient functioning of commodity markets. I've tried to make that point. It's gone on for many, many years, decades, centuries. It's not going to change now. As IOSCO put it, and I've got another quote here which I thought I'd just tell you, and this came from an IOSCO report on the commodity derivatives markets, and this is what they had to say. This regard, Task Force 2009 review of available literature led it to conclude that existing economic research did not support the proposition that the activity of speculators has systematically driven commodity market cash, physical or futures, prices up or down on a sustained basis. That's IOSCO. And for those of you who don't know IOSCO, that is the combined group of regulatory authorities around the world. That's the conclusion they've come to. And they have no axe to grind about this. So, want to bear that one in mind. Last point, and then I will stop, is the World Bank has actually led the way forward in many respects about using derivatives to manage price risk. The problem is that in the producer countries, it's very difficult for them to be able to afford that. And I did have a headline here somewhere, which I think is quite interesting, but I don't seem to have it with me. But I will tell you what it was. The World Bank made an announcement just recently saying that they just cut a deal with one of those wicked speculative banks in the order of something like £400 million to provide a hedging mechanism for small-sized producers. That is in deprived countries. So in other words, whatever one may say about them, that is a manifest demonstration of just how important bank participation in these markets is. Thank you.
Right, thank you very much to both our speakers. We've now got around 25 minutes for discussion. So is there anyone on the floor who has any questions? Yes, over there, the gentleman.
I'd like to address my comments primarily to Deborah because I really want to be on your side. I've long been a supporter of development charities, but I work in the city. And I'm most grateful for the way in which you've made your comments. I happen to have just read the Food Watch report. It was the Christian Aid one before that. And virtually everything I read on this subject, which is campaigning on your side of the argument, frankly is full of nonsense. Because I want to make sure that, like this evening, we have a dialogue rather than a diatribe. And too many of those reports contain statements about activity that is purely speculative, betting, legal market rigging, and phrases that are guaranteed to suggest the person writing the report doesn't know what they're talking about. So I'd encourage you, as you're working with these various bodies, to make sure that the words that they're using are ones that professionals in the market will recognize as bearing some description of reality. Because for me, as soon as I read things like that, I switch off. I assume they don't know what they're talking about. Some of the better reports are very good at explaining the hedging process from start to finish and the way in which people along the food chain might want to hedge their positions. But I'm disappointed that you, like they, fail to carry that through. When you're describing the impact of food price changes on poor people in this country, it strikes me as slightly odd that you are campaigning against pension funds representing those individuals, bearing in mind that they are representing individuals, not just evil institutions themselves. Why can't they use food derivatives to hedge those food price rises? That would seem to be a perfectly natural hedge, just taking the analogy one stage further, and yet it is condemned as purely speculative. Sorry, not in your comments, but too frequently. Many of these comments assume that price rises of this sort can't happen except for deregulation. Some of them even include charts that demonstrate that the same price rises did happen in the 1970s before deregulation. So if what's going on is purely because of deregulation, please explain why it could happen before deregulation.
Okay, Deborah, before you respond to that, I want to take a couple more questions. And can I ask, so that as many people have an opportunity to contribute as possible, can everyone try to keep their questions quite short? Yes, the gentleman at the front.
A question for you. You said you didn't like the idea of excessive speculation. Are there any mechanisms you can envisage to prevent excessive speculation? And what's your view on a global Tobin tax?
Okay, and can I take one more question before we... Does anyone have one? Otherwise, I'll throw in one of my own. Yes?
Just a question to both of you about the short versus the long-term impact of what you're saying. If one of the comments you made was that it's difficult for both producers and I suppose governments to predict what future prices will be. So whether those prices are, if they are to stay high, there's an incentive to invest in further production or alternatives. Equally, if those prices might be low, there's less incentive to invest. At the same time, I suppose my question would be, do you think there is a moral duty on some of the markets, given that this impact will affect individuals across the world who are buying food, to consider that? Because in the long term, yes, if the market's reflecting the true price, that may well allow producers to be comfortable investing in new technology and alternatives. But if in the short term that means pain for a number of people who are the end consumers of those that food, and their income cannot support them to purchase more, is there a moral argument for markets to take that into consideration?
Okay, great. I'm going to give Deborah the first chance to respond. And Deborah, can I ask that you try to keep your response to around 5 minutes so we've got time for
5
another
minutes.
round?
I'm not sure I can speak that long. I'll do my best. Just a bit of a caveat. I mean, as campaigning and advocacy organizations, we do speak to different audiences in different ways. I would urge you, if we only have one copy here, but we can certainly send you one, if you haven't seen a copy of our Broken Markets report, which is tailored to an audience like yours, if you will, that speaks about how do these markets work, how are price formation issues passed down. Hopefully you won't find it provocative and inflammatory as you suggested. But these things are inflammatory and these things are provocative, and it's important for us to use that language when we're certainly speaking to the public. I think your main question was, did this happen before deregulation? We had price spikes before deregulation. My understanding is certainly that it did not happen in the same extent and not these types of massive spikes that we're seeing every couple of years now. And because of those long-term pressures, we don't deny that there's long-term pressures on food prices, and we also don't deny that there is a legitimate role for hedging of different actors in the market. What we are concerned with is the short-term, herding, speculative and manipulative behavior, which can only be managed through better transparency in these markets and through position limits. And that's what we're concerned with. We have never said that there wasn't a role for legitimate hedging. That's one point. Can I just mention something that Anthony referred to earlier, and then I will come back to the other question, which was where the evidence is coming from. The World Bank report that you've cited heavily from, or rather the OECD report, was quite discredited, and the methodologies used in that report were discredited shortly thereafter. And in fact, the World Bank has come on side to say that they do think there's a problem with short-term speculative behavior. A report from the G20 study group concluded that there was a growing body of research that now supports the view that financial investors have affected price dynamics over the short term, and these are the short-term price fluctuations that we are talking about. A recent UN report also backed this. Michel Barnier, the Internal Commission of European Markets, supports the view. The head of Unilever has supported the view and come out on side. Olivier de Schutter, the UN rapporteur on the special right to food. I could go on. There is actually a growing body of evidence to support that this type of short-term financial speculation is a problem. Your question was, is there a moral duty? I believe there is. I mean, I come from a development organization that looks at, we talk about this all in theory about what's happening in the short-term fluctuations, and eventually price discovery will come out at a price. Well, if that process of price discovery, if it takes a month or 2 months or 3 months to come to whatever the legitimate price is, if that's having a massive impact to people on the ground, we do have a moral duty. And I think that is, that's part of what the role of governments is to look at their moral duty to provide for the social needs of their populations. And if that means interfering, with free markets, which are not really free because actually there isn't effective information, then so be it. And I think that is something that I would hope that the events of the last year would the city might reflect on.
Great, thank you very much, Deborah. Anthony, 5 minutes.
Okay, battle of the reports. I mean, I'd only commend this to you, which has reviewed 20 of them. And if some of them have been discredited and some of them haven't, at least that's a summary. And the conclusions I mentioned were an extrapolation of all those reports and their findings. Again, you did use that phrase, speculation and manipulation, and I keep saying you've got to unpack this, because one is a criminal offence and one isn't. And I really think you need to sort this language out. In terms of the response to the question about excessive speculation, what will happen? Let's take an example. A trader is found he will have his positions will be exposed to the exchange, so the exchange will know what positions they've taken in the market. If it's seen to be distorting the price, then what will happen is the exchange will go to the trader concerned or the company concerned and say, we want you to unwind that position and take it down to a certain level that's more tolerable. They won't say, because it's speculative, you're not allowed to do it. They'll just say, take it down to a level that's tolerable and consistent with a reliable price formation process. And there are other means. There are position management. It will include position limits. Position limits are not the cure for everything, but they are a tool that every regulator should have in their pack in certain circumstances to be able to bring out circuit breakers. There are all sorts of other things that exchanges can do. The issue about moral responsibility of markets, if I were to say to you, if you go to court, you hope you will get a true judgment. But basically what you'll get is a judgment based on the evidence. So if the evidence is deficient or somebody is perjuring themselves, you may not entirely get a truthful judgment. But the point of the court is actually to come to a judgment. It's not to go beyond that to social services, probation services, all those other things. So where I would say the moral responsibility of a market lies is to do everything it can to make sure that that price formation process is revealing true prices on which other people can act economically and in all other ways that we've been talking about. So I would say that's the moral responsibility of a market. I think it would be, you'd be hard pushed to stretch that moral responsibility, which says, well, if somehow the prices are unacceptable, should the market do something about it? No, they shouldn't. It's for the government to do things like that. And as I say, targeted subsidy at points of consumption, making sure that distribution and aid are all getting to where they're going to and don't go via local governments, which are very often corrupt. There's lots of things that can be done, but I'd just say I'm not wholly convinced that somehow a market has a moral responsibility and the market supervises us. It lies in the price formation process, I think.
Great, thank you very much. Right, we have time for another round of questions. Yes.
Thank you. Just quickly, because you mentioned in the beginning of your speech, sorry, in your speech there, you talked about biofuels. I've actually looked at food price inflation as part of my job around that time, 2008 as well. And of course, you had a massive spike and it fell right off. Food prices fell right off. Now, from the data I saw, the land that was used for biofuels hadn't actually changed. So you can't claim, on the one hand, that it's pushed prices up, and then when prices are falling, you know, this doesn't quite add up. It probably hasn't had much of an effect on food price inflation in the first place, or at least it's debatable. And then I have another question for you. I find, your point's very convincing, of course, but surely if you've used the market to find a price for, let's say, Greece's debt, or let's say Lehman Brothers bonds, just before Lehman goes bankrupt, you surely have a problem that the price reflects one thing one week and the other week it's completely different. So that to me suggests that markets do have a role to play, but surely that's not all there is to it.
Okay, great. Any more questions? I think I saw some hands over there previously. Don't be shy, yes?
I think the point is, you've said that the moral point of markets is to produce clear, transparent prices. If markets succeeded in doing that, I'm sure we'd all be delighted. You mentioned the Greek government. Sorry, are you hearing me all right?
Sorry, I can hear. It's okay.
You mentioned the Greek government. If the markets are so smart, why did it take them quite a few years to realise there was a problem in Greece? Morgan Stanley helped the Greek government lie. The financial markets, in all their marvellous competence, didn't manage to work that out. You get the herd effect in markets. This is well acknowledged. Somebody goes in one direction and everybody else piles in. The financial mess we are in is because the markets badly miscalculated. RBS now admit that they didn't do even basic checks on ING. There's another point I want to make. I've got so worked up I've forgotten it.
It's all right.
The other thing
I'll try and deal with them all.
Is when we go on about markets, we're assuming that economists, as economics is simply taught, has this nice little theory that you have brilliantly competitive markets and so on, and we sit there and we quote wheat as an example. Unless the situation has changed, the wheat market is almost totally controlled by cargo. It is not competitive.
And any other questions? Yes? At the back there.
This is a neutral question. I think you've touched on one of the points, which is one of the problems is that world supply of food is not actually increasing and not enough is being done about this. I don't think that either of you have really addressed this issue, With growing world populations, we have more mouths to feed, and there seems to be an absence, both from the markets and in terms of governments and international governments, in terms of actually increasing worldwide food production. What do both of the parties comment about that?
Great, thank you very much. And I'm going to let Anthony respond first this time.
Quite a lot of stuff was thrown at me then. So, I'm obviously not going to comment on particular companies and what they do or don't do, but I would say this about the herd instinct. You're absolutely right, but we all do this. It's a human nature thing. We all tend to drive sometimes in the same direction together as a group. And it's equally true of markets. And if you think about it, if you have circumstances in a market which are going to cause fear that the price is going to go up or going to go down, and those are in the newspapers and those are well publicized, guess what's going to happen? Everyone's going to jump in and go one way because of that. So I think you're right, it's upsetting to see that herd happening, but it's a real human nature thing, and it happens across all sorts of economic activities. Well, they're regulated. They're not self-regulated. I mean, they are regulated. But I think, let me come to the other point about production. You're absolutely right. I mean, I did mention that there were serious problems about production and massive underinvestment. And, you know, the CAP has not helped because it's preserved inefficient farming, small farming, along the Mediterranean and things of that nature, when actually those farmers should become much more efficient. Now, okay, it's nice to think of preserving small businesses. I don't quarrel with that, but it's also preserved deep inefficiencies in production. And you're quite right. I think the figure is by 2050, we're going to have to reduce food production by 70% if we're going to even reasonably feed the world's population. That is a massive call, and I'm not sure we're going to be able to do it without going into unacceptable forms of food production. But I didn't address that in great detail because we were there to talk about commodity markets, so forgive me for that. What else did I have to ask? Herd effect, I've tried to do that. Corporate governance. When you mentioned the crisis, you're absolutely right. It was a huge failure, not on the part of all banks, but some banks. I mean, we have to be a bit careful about this. It was some banks. And there was a massive failure in corporate governance at the high end. And it was driven by the kind of philosophy that says, we're big, we're operating in so many countries in the world, we have thousands of staff, we're trading in 30 markets around the world, we can walk on water. That was the psychology that was sat in many boards. We got all the best systems and controls in the world. And of course, the whole thing was found to be flaky in the extreme, and we all know the distress that flowed from that crisis, and we don't need to go into all of that. But that was a manifest failure in corporate governance at the highest end, and a failure to behave ethically or responsibly to the system of which you are a part. And I think, if I just finish very quickly on this, I think the problem was inevitably at a board who are accountable to shareholders, and they're asked, is this a good thing to trade in or a bad thing to trade in? They will probably say, well, it's not about that. It's about, are we going to make money or are we going to lose money? I'm not defending that. I'm just saying that's the reality of the argument, because they have shareholders who expect them to perform. They have all sorts of people who are driving them to perform. The problem was nobody stopped and said, irrespective of whether we make money or not, and this, whether it's a good thing or a bad thing, is it we are an integrated, seriously important part of the financial system? Should we be doing that? And I'll bet you that was not a question that was asked in any of those boardrooms at all. And right now, it's going to be a question that's going to be asked very, very seriously indeed. So I just think it's a corporate governance problem. And hopefully we're getting that right. Sorry.
Deborah.
Sorry, I was on a panel with the chief scientists at a Soil Association conference, agreed that there is enough food on the planet right now to feed the world. There is enough food, probably, production to feed 7 billion. Now, when we get to 9 billion in 2050, that is absolutely a problem. We do need to invest in agriculture. But actually, the World Bank, your friend, has said and agreed recently that it is smallholder production that we do need to support more, not large-scale agriculture. So there's a lot of myth-making around what type of agriculture will feed the world. The vulnerability has increased in developing countries significantly for those who have embarked on export-led strategies. And in fact, we've seen countries be far less vulnerable to these food price spikes who have actually prioritized subsidies for local smallholder producers, countries like Malawi. And there's a growing body of evidence, both the FAO and the World Bank have supported that approach. So to say that it's going to come strictly from global markets investing in big agribusiness, I think, is a bit of a myth. I think Anthony was actually agreeing with me. I think I heard you say that position limits should be in the toolkit of governments and that we should have transparency. These are the two things that WDM is asking for, and our government is not yet behind position limits. And that's what really is the barrier now to seeing this European regulation, which is going through right at the moment, go through. And if the Futures and Options Association is behind that, I think we could see much more effective functioning markets over time. What's happening now, you say manipulation is illegal. Well, actually what Anthony Ward did was perfectly legal. What those other commodity traders who I would argue have manipulated the markets for their own ends has been legal, because we don't have these two things in place at the moment. So actually, this is not a debate in the end. We may disagree about whether or not we have a free market and if a free market works, but actually if you think governments need these things in their toolkit, then that's fantastic.
Great, thank you very much. Well, we're coming to, towards the close of this evening's event, but I think it would be quite interesting just to sort of take a survey of opinion out there on the floor as to whether or not after this debate you're leaning towards Deborah's perspective, you're leaning towards Anthony's perspective, or you're still just not sure. So firstly, could I get a show of hands if you're leaning towards Deborah's point of view? Yeah, okay. And Anthony's point of view? Okay. Yeah, and then is everybody else undecided? It's very reasonable of you. Okay, well, I think then there's nothing left to do apart from to thank our two speakers. Thank you, Deborah. Thank you, Anthony.